Smith Group, using an engineering approach to investment management.
At Smith Group, we are defined by a careful and comprehensive approach to assessing earnings quality in the companies we own for our clients. It is an objective, data-driven approach that grew out of my background as a NASA engineer prior to the founding of the company.
Quality earnings at Smith Group are defined in several ways. Ultimately, we're looking into a company's financial statements to determine the conservative nature of their earnings, the degree to which the company has really been digging to hit the numbers and kind of struggling with headwinds. And so we look at things like whether or not inventories are increasing or decreasing. To what extent is a company able to convert assets to cash flows? And are they improving that process, or is that process really grinding down?
When reviewing the earnings quality and really the validity of the business model and fundamentals of any company, the scope of factors that we analyze at Smith Group is exceptionally broad. They include not only a range of operational factors, judging how well the company is executing on its business model, but we also take a very close look at management compensation and board composition to judge whether management's incentives are aligned with the interests of shareholders.
That ultimately helps us achieve our goal of owning companies that will have a higher chance of growing their earnings faster than the market expects. And what we've found is that we have been able to consistently identify and invest in companies that do report a much higher percentage of positive earnings surprise than the overall market.
While in many ways our analysis has a traditional fundamental orientation, the range of factors we address also includes some non-traditional elements, which suggest that Wall Street analysts commonly get behind the curve in adjusting their earnings estimates to the upside when a company's business prospects begin to improve.
We look at in excess of 20 factors for each given company. Each of those factors could broadly be broken down into kind of three categories, and that would be accruals, changes in inventories, net operating working capital, asset utilization, which is another way to say management efficiency, as well as cash flow. How does the cash earnings of the company look relative to the actual GAAP earnings of the company? You want those two to be as close as possible, which is an indication of really the quality of the earnings that are being generated.
The effectiveness of our approach is represented in our long-term results. Our large-cap core growth equity strategy has had very solid returns over a decade. The average annual return above the S&P 500 has been almost 300 basis points per year, net of fees. When you think of Smith Group, think of a highly engineered process proven at finding durable growth opportunities, often ahead of the street. The net result to our portfolios has not only been an above-market market performance, but also a muting of downside risk. In fact, we have not only outperformed the S&P 500 over the short, intermediate, and long term, but we've done so with lower volatility.
If you would like more information about Smith Group and our approach to the early discovery of high-quality earnings growth, you can visit us at www.smithassets.com or call us at 800-582-3435. This is not a solicitation to invest, and past performance is no guarantee of future results. Before investing, please obtain additional disclosures with complete information about fees, risks, and other important considerations.